Welcome everyone to another episode of The View from the Arch. I'm Dhruv Patel alongside Himanshu Sahai, and together we're the co-founders of Arch Lending, the premier destination to borrow against your Bitcoin and crypto assets. And today we're really excited to have a conversation with Nathan McCauley, the co-founder and CEO of Anchorage Digital, the leading crypto custodian amongst a variety of other service providers. Nathan, thank you for joining us.
Pleasure to be here, guys. Thanks for having me on.
Awesome. Maybe we can start, Nathan. You came from like the engineering background. Most recently, I think before Anchorage, you were at Square. What prompted you to like leave and start a company, and specifically like within the crypto space?
Yeah, it's actually a fun question. So I, like you said, started out within engineering. I think as many people who now are professional programmers or software engineers started from a very early age. I went to a summer camp. The summer camp, oddly enough, had coding, and so I've always been within software engineering for my career. Was lucky enough to be an early employee at Square, so got to see it go from 40 people to 1,400 by the time I left, just ahead of their IPO. So got to see a bunch of great stuff there, and the whole reason I kind of got into Square generally was that I moved from Indiana to San Francisco on the assumption that the cool tech got built in Silicon Valley. And so I thought to myself, okay, I got to go be an immigrant basically and move from Indiana to California and figure out this whole tech thing. And so got myself involved in the tech scene there, on the hope that maybe if I worked at a successful startup, I would see how to do it, maybe meet some friends, and be able to start a company one day. And so the plan came together, joined Square early on, ended up getting to work side by side with who would go on to be my co-founder, Diogo. And we just had a blast building a bunch of cool stuff at Square, everything from the reader to back-end security systems that stored all the credit cards, et cetera. After about 4 years at Square, we decided to go out on our own, but we didn't have a good idea yet. And so instead of actually starting a company, we both joined a company called Docker together. Yep. Docker cloud computing technology. A lot of people use it. And it's there for software security, basically. And so spent some time there waiting for a great idea that would kind of match up with our skill set. That brought us to about 2017, where crypto kind of, for the first time, really entered the zeitgeist. Specifically, Bitcoin entered the zeitgeist, and people were, everybody at Thanksgiving that year was talking about Bitcoin. So at that point, decided, okay, this is probably the chance to go start a company. There were a bunch of people reaching out, asking for help with custodying of their private keys. And so just kind of looked at the landscape and said, okay, institutions are probably going to want to come into this space. Retail is well served, but institutions are actually oddly underserved. Let's build an institutional custodian and solve a couple of problems that we thought were the most fundamental problems. The first one was, could you build a custody system that's actually usable, easy to interact with, and still be absolutely safe at the same time? So the state of the art was cold storage. Take the assets, turn off the computers, keep it offline, and then it would take hours, if not days, to actually get the assets out. And so that was the state of the art back then. We thought, hey, we can do much better. And the other thing that we thought we could do much better is we could get the whole thing regulated. And that would be able to pursue regulatory licensure, combine great tech with great regulation, and then that would be the way to go serve the world's institutions in crypto. In hindsight, I was probably naive about how hard both of those problems would be. And so it was a lot of work and a lot of struggle over time. But then, ultimately the plan worked out, and the story of Anchorage has been a really fun one, and we're doing very well now.
Well, I think you had one key win, which has been central to your story, which was the OCC charter, which kind of set you up as the most regulated custodian out there, and like still to this day, that's true. How did you decide to go for that when other custodians, even today when they're much bigger, have not gone for that? And then how did you, for lack of a better word, outcompete the other custodians, because custody has become a very crowded space since then?
Yeah, so I think it's a really interesting question. We started on our journey to become regulated by attempting actually first to get a broker dealer. So we went to the SEC, met with them a lot, and that path was clearly not open when we were thinking about it in 2018, 2019. So pivoted the strategy there to get a state chartered trust. Once we got the state chartered trust, we were able to, when the opportunity was right, convert that into a national trust. And so a lot of the most complex part of becoming a national bank is in that initial application process. We basically have to treat our state chartering time as a preview of what it would look like to be a national trust. And so through that conversion process, we actually turned our state chartered entity into a nationally chartered entity, which allowed us to basically draft off the fact that we had been doing so much work there for those years. In terms of competitive dynamics and kind of thinking through how we compete against other custodians and how we really differentiate ourselves, I'd say the first most important answer is that if institutions are going to come in, if the large asset allocators in America are going to come into digital assets, they need to see not just one custodian, but a good set of options. And so the first thing I would say is that the pie growing is kind of dependent on there being opportunity to do counterparty risk diversification. Right. After 2008, every institution wants to hold at more than one location, and so that's the most important thing to think about. That said, we still do want to compete and we still want to win, and so we tend to win on institutional focus, customer service, and then I think still most importantly the ease of use of our platform. A lot of the other custodians still focus on things like cold storage. It's very hard to get their assets out. It's very hard to say participate in staking, governance, things like that. Whereas we are doing everything we can to allow direct access to assets, support new chains on day one of their launch, and allow interesting stuff to be done with those assets. As an example, we support Bitcoin staking through the Babylon interface out of Anchorage custody within the qualified custodian. And so that's the kind of thing where we try to keep ourselves on the bleeding edge of innovation. And that allows us to capture a lot of the net new flows that come into crypto, serve those clients very well, and then continue to grow from that asset base.
Yeah, that makes sense. And I mean, that's something like Himanshu and I have thought a lot about. And if we've incorporated that into Arch as well, like the two key pillars of just ease of use, as well as just like the transparency and security that you bring to a business of like pillars that we think about as a lending company. Nathan, curious on your side, what is like the vision for Anchorage now moving forward? Like, do you think custodians, I know you guys also offer like OTC and a variety of other services, as you mentioned, staking. Do you think it sort of like merges with exchanges in some point in terms of like the full stack services that you offer institutions, or how do you sort of see that playing?
So I think there's a lot of interesting ways for this to play out. If you look at the traditional asset market landscape, just the kind of market structure, I guess, you don't actually see that much combination of custody with exchanges. And so like the New York Stock Exchange never actually holds your stocks. The Forex markets never actually are the custodian of the Forex assets. Stocks, bonds, equities, kind of across the board, every single asset class, you see a segregation there. And I think there's actually real wisdom in that. I don't mean to be a Luddite or sort of like kind of pseudo Amish compared to the way that like the crypto people feel about it. But I do think there actually is wisdom in that segregation. And I think you're going to see more and more traditional institutions come in. They're going to want to see that segregation. And so I do think over time that the exchange function is going to be separate and distinct from the custody function. The custody function is going to be increasingly about holding assets and allowing them to be productively used. Say, getting buying power on exchanges from your deposit base in a custodian, allowing tri-party setups where you can hold the assets in a custodian and then do things like you guys do, which is like lend against the assets. And then over time, there's this whole wealth of fun and interesting things that you can do with the digital assets themselves from within the custody perimeter. So staking as an example, participation in DeFi, voting and governance votes, and settlement services, all are kind of interesting features that can be built into the custodian. And so the crypto custodians, I think, look tangibly different than the traditional securities custodians. And that's what makes it kind of a fun and interesting business to be in.
As the flip side of that, What do you think of the major exchanges now buying up custodians or operating their own custody services as well, as an opposing point to what you just said?
Yeah, I think it's natural to think about that and want to try to be in that space. I think it's very very challenging to enter the custody space right now. I've often joked that I wouldn't recommend it to my friends. It's actually very hard to get scale. It's very hard to get the trust, and I think people think that you're going to kind of draft off of the brand or the reputation that you have, and use that as the mechanism by which you can drive a deposit base in. That's actually quite a lot harder than that. And so there's a kind of an effect to scale that I think naturally leads in this direction. I also think there's a real tangible possibility that the market structure bills that come out over the next, say, year are going to even more formally ask that custody and exchange are separated. Just again, because that's the wisdom that we've seen across the landscapes. So I don't blame people for trying. It's actually a really fun and interesting business. So I don't mind that. But it's actually like quite difficult to build it up, and so I think it'll be interesting to see how that plays out over the next several years.
Speaking of regulation, so like something that people have been talking about a lot recently, which I'm sure you've answered a ton of questions on, is SAB 121 getting repealed, banks getting into custody. Do you view this as competitive to you? Is it growing the pie, or are you going to be the one powering that lending powering the custody for them?
Yeah. So SAB 121 is really interesting. It was a hilariously specific accounting rule that seemed like it was a specifically designed regulation to keep banks from becoming digital asset custodians. And so it was, and at some sense, I got to say, like, if your goal was to cut banks off from being able to do it, then kudos. It was
right.
It was an incredibly well put together piece of accounting nuance that achieved that objective for a period of time. And so what I would say there is that for the period of time while SAB 121 was in effect, was actually a great boon to our business. It basically gave us a government-sponsored monopoly, which is like kind of tangibly unfair. And so we actually advocated against it, despite the fact that we're probably the only company in America that actually benefited from SAB 121 coming forward. That said, we had at least a half dozen conversations with large banks where they were going to use us as a sub-custodian for their digital asset offerings, all of which got killed by SAB 121. And now those conversations are coming back. Okay. Those conversations are coming back where they're starting to say, like, hey, how do we re-enter the digital asset space? It looks like things are going to be kind of more open under the next administration. What does it look like for us to come in? And we want to partner with somebody who's already regulated at the same level, or maybe even in some cases higher than us. Right. Sometimes there's national or large state banks, and we've got the national bank, and so that partnership is going to be a really natural opportunity for us to go after more of that landscape. So I don't consider it competition at all. Rather, it's looking more and more like we are going to be an enabler for those banks coming into the digital asset ecosystem.
Yeah, and that makes a lot of sense, I guess. Like, it's so hard to stand up a custodian. Yeah. Himanshu and I have had the ability to evaluate many of the players out there, just given who we use. And you see the variance of technology across the space. And so it certainly makes sense that these banks would look to just build on top of Anchorage or sort of rely on that infrastructure.
I mean, it's a huge, as we mentioned, we've evaluated and used multiple custodians in the past. And I think most products in our experience have been extremely buggy, to the point where, like, we're worried about losing our funds, whether it's a UI glitch or it's something else. We don't know, and that worry is not something you want to have when you're moving 8-9 figures of capital or more. And I think one place where you guys, I think, have won really well is your SLA. As simple as that sounds, most custodians have a 24-hour SLA. You have a 1-hour SLA, or I believe it might be even shorter. And that is just, at least from our perspective as a lender using a custodian, it's a complete game changer. Because if we need to liquidate a position, we can't wait 24 hours to liquidate that position. The market's going to fall from under us in that time.
Yeah. No, I was going to say there's basically like so many nuances
Yeah.
to building a custodian, and I'm sure Nathan, you know better than anyone else out there that it might seem easy on the surface to say like banks are going to enter and build their own, but it seems completely sensible to just build on top of existing
Yeah.
providers such as yourself there.
And banks are not known to have the best tech teams either.
Yeah, I mean, I think one of the ways that I think about it is if you look at who has succeeded in running a digital asset business in traditional Wall Street finance, you've basically just got Fidelity.
Right.
And I would say what Fidelity has pulled off is a modern business miracle. They were early to the game. They launched FDAS and have built a meaningful business on top of Bitcoin. The problem there is that the success that they've had is limited to Bitcoin.
Right.
I think they've now got ETH, but haven't been able to go, say, to ETH staking or any of the other assets. And so I think as we look at the landscape where there's probably going to be dozens, if not hundreds, of meaningful chains over time, the level of complexity that is available here is really insurmountable for a traditional institution to really wrangle in terms of complexity. Yeah. And so I think that is what drives a lot of the partnership with us over time is, sure, we've got incredible tech, we've got incredible licensure as well, but even just getting to the asset support problem, which itself is nearly insurmountable, is a big reason that I think many of the players are going to want to say partner with someone like an Anchorage.
Yeah, that makes sense. And we've been fortunate, Nathan, to have you as an investor. But one of the things we've spoken about over the 2 years that we've gotten to know you is borrow lend, specifically in the crypto space for obvious reasons, just given that's our business. But I was curious, like, Anchorage had seen that prior cycle. What were some of the lessons like you saw from that cycle from the borrow lend side, but maybe even broader, as it seems like we're starting to really see another cycle come up in crypto. And so I'm curious what learnings are top of mind from you from the last one.
Yeah, I'd say the most important lesson is one around having a clear mind around what is a properly economic financial transaction. And the reason I say that is that if you look at kind of lending markets in the 2022 kind of landscape, there's a bunch of things that were going on that were fundamentally non-economic. The risk versus reward trade-off on some of the things that were happening at scale just wasn't right. And so being able to keep a clear mind and a disciplined risk tolerance in light of all visible signals pointing in the other direction was a really important lesson. And I think that lesson actually generalizes whether it's across lending markets or if it's across, frankly, some of the things we're seeing with meme coins. Mm-hmm. There's a lot of kind of general purpose things here where we're in a trend, we're in an industry with notably, I think, some sharp edges that need to be like very carefully considered. And so I think that's a big one. The other one I'd say is we had an incredible amount of interesting success in our lending program that was based on underwriting, not just based on the information clients had given us, but on their blockchain activity. Yep. And so that ability to not just look at what you can see because the clients have provided it, but what you can look at on chain and having that be part of the underwriting process was fantastically useful in ways that I don't think a lot of people have necessarily like come to terms with how much incredible data there is on chain and how that can be used as part of an underwriting process. We're starting to see some of the decentralized chains start to look at this stuff, but I think it's going to be more and more interesting over time to look at that as an underwriting signal, the transparency that comes from on-chain data. Yeah,
I think over time as lending gets more mainstream, it still isn't in crypto, right? It's a very small percentage of total. Like credit as a function of crypto is still a very small percentage of the market cap. But as it gets more mainstream and things like under-collateralized and uncollateralized lending come back, it'll be very interesting to have that kind of robust underwriting beyond just the financials of the company and what they provide you. Because all that is available, as you mentioned, and it can give you a much better heuristic on what to look for. And it's probably completely different from traditional financial underwriting.
Yeah, I think so, and I think that's going to be, there's some people talk to this idea that even some of the things we saw in 2008, if there had been more transparency in the markets, more understanding of who had risk where, there were some aspects, and you talk to, like, say, Christian Carlo, who used to run the CFTC. One of his positions has been that actually there was less issues in the market than we thought, and some of that transparency might have helped with mitigating some of the risk there. And so just like a kind of a tangible example of like moving more stuff on chain, being able to look at some of these positions can actually be really helpful, not just at a like individual underwriting sense, but maybe also in a systemic sense.
Right. Yeah, that makes sense. And I know we started off the conversation, Nathan, with you saying like the big question was if institutions come. And earlier on in a podcast episode, we had Michael Sonderstein here and had the ability to ask him what he saw in institutional adoptions at Grayscale, but that was more from the ETF angle. Curious, what are you seeing? Because I know a lot of sovereigns and other large institutions are customers of Anchorage. Are they looking for spot Bitcoin exposure? Are they looking for sort of more general crypto exposure? What are you seeing in terms of like appetite here?
It's a wonderful question, and so we're, as a custodian, it's nice to be situated where we are because we get to see all kind of a piece of all versions of that. We've got large public companies that decide to buy their Bitcoin through us and hold it at Anchorage. We've got like you mentioned, sovereigns who think about allocations into Bitcoin or other assets and then hold it with us. But then we're also downstream of some of the kind of options positions or derivatives positions that people want to get access to. We're downstream from some of the ETF positions where we custody for some of the ETFs in large quantity. So we're holding billions for some of the ETFs. And so we get to kind of see a mix of what those use cases are. And the easiest answer is yes, it is spot. It is derivatives. It is wrappers like ETFs. It is buying shares of public companies as a way to get exposure to Bitcoin. Mm-hmm. So any and all ways that people can get access to Bitcoin price action, I guess you would call it, right, are being considered. And that's really kind of the story that we saw playing out over the last couple of years, is just that variety of different incarnations of people looking to get access to Bitcoin. And I think that'll continue. I think we're going to see with the ETFs a real opening up of that aperture where there's going to be able to be more spot single asset ETFs, which will just be the beginning. I think honestly, those are interesting, but interesting as a novelty, but over time shouldn't be that interesting because it just holds a single asset. It shouldn't be that interesting to just wrap up a single asset and make it into an ETF. Even if you look at something like the ETH ETFs, ETH ETFs are not nearly as successful as the Bitcoin ones. Right. But I would say they're an incredible story because that is a half product at best. Doesn't even include staking. Mm-hmm. And so somehow this like truly hamstrung half-built product has gotten so much demand. And so that's like to me, that's like an even bigger story than the success of the Bitcoin ones, is that like the ETH ones have had so much investor demand, despite the fact that they don't include the staking component. So once you start to add staking into those, once you start to have multi-asset ETFs, you're going to see even more institutional adoption and more interest in, say, direct spot exposure, because many people will decide, hey, I don't want the ETF wrapper, I want spot exposure. And so I think it's all kind of helps out with the adoption curve of digital assets.
I think I saw recently that someone is trying to include staking in one of the ETFs. I can't remember which one it was exactly. I don't know if you saw the same news somewhere.
Oh yeah. We're tracking that whole area really closely. We're a really natural partner to the particularly to the staking ETFs, because our bank charter specifically allows us to participate in staking.
Right.
And so we got the bank charter with the OCC, and one of the specific call outs is that we're allowed to participate in staking. And so a lot of the ETFs that are starting to look at how do we participate in this ecosystem are like, hey, I want to work with a national bank that's allowed to do this, because staking is specifically approved, and there's kind of a federal government entity saying that staking is allowed. And so yeah, we're paying very close attention to that, and I think it's going to be one of the big themes for the next year.
Well, so Nathan, you have access to the holdings of most of, or a lot of the big institutions, sovereigns, and other kinds of agencies. Does that open up an avenue for you to at some point use that data to create some kind of asset management division?
So this is it's like a common move, I would say, among large banks. If you look at like the large Wall Street firms, almost every large Wall Street firm has some sort of an asset management division. There's clear separation of being able to see what clients are doing versus like what's going on in those asset management divisions. I haven't even begun to think about what it would look like for us to do something like that. So, I'll take that under advisement that it's kind of an interesting idea for us, but I think it's too early in our journey to be thinking about an asset management arm for Anchorage.
Yeah, that makes sense. What are some of the other interesting or exciting opportunities, Nathan, that you see in the crypto space right now that maybe Anchorage is not pursuing, or ideas that if you were not working on Anchorage, this is something that you'd be working on? And then particularly, I want to touch on USDG afterwards as well. But yeah.
Yeah, so actually, you cut to the chase on that one. That's USDG is we are working on that. We are one of the founding crew that has put together USDG, and so I think that's big. I think that if you just look at kind of what's happening within stablecoins right now, you have something like a couple $100 billion in dollar-denominated stablecoins out there. And this is basically just crypto using stablecoins ourselves. Most of this use case is like for trading, or it's out in DeFi activity. That is just barely scratching the surface of what can happen with stablecoins. The fundamentally interesting thing about stablecoins is that you can take the dollar product and remove the barriers for distribution. And so you've got, I like to think about currencies as natural monopolies. So a currency should spread the entire globe over in the same way that, say, a social network did, like Facebook or others. And so currencies ought to be natural monopolies. But the dollar hasn't necessarily gotten to the point where it's truly global in nature. And the stablecoins are going to allow that. I think this is why you see the executive order that came out of the Trump administration saying that stablecoins are a strategic asset of the United States.
Right.
And it's not because it's going to be used for DeFi pools. That is not why it's a strategic asset of the United States. It's a strategic asset of the United States because it's going to help with dollar dominance for the next century. And so I think this is the biggest story in crypto coming up. And it's funny to say that because it's already the biggest story in crypto. If you look at, say, just block space and how many transactions on each of the blockchains is one side of the pair is a stable coin. It's already the biggest story, and it's just getting started. And so I think that's the biggest area within blockchain and crypto that has an opportunity to grow. If I was to mention another one, I would say generally the industry is trying to figure out how tokenization will work. And so stablecoins make sense. Dollar product propagate the world over. What does it mean for all of the traditional assets? Come on,
right.
Stocks, bonds, equities. So much of the infrastructure that we've built, so much of the risk management that we've built has an embedded assumption that we have to have slow settlement times. And so it's almost like, if you look at the other custodians in crypto, they have slow settlement times, and that presents real risk to you guys.
Yep.
Well, guess what? That's the entire traditional financial markets right now, is they have slow settlement times, and there's a bunch of risk that is inherent because of that. Can we build a fundamentally better financial infrastructure because we have faster settlement times? Obviously. The question is how. And what is the path to get there? That's what crypto I think really needs to figure out, and it's exploratory at this point. We've got little experiments with say the success of BlackRock's Biddle.
Right.
Some of the stuff that say Securitize is doing is really wonderful, but I think this is a big area and worth kind of thinking about long term.
Yeah, we're actually making an effort in this at the moment, as we mentioned earlier off camera, with the tokenization of our debt facility, where it'll be the first kind of, call it securitized private credit, or like securitization in crypto, where it'll be giving access to tokenized private credit with obviously instant settlement and such.
Yeah, and I think and Nathan, I agree with your two takes there of the exciting aspects. One thing I just wanted to circle back on is maybe could you articulate for folks that might not know what USDG really is and why it's unique relative to like a Circle or a Tether or some of the other options out there that are sort of stable coins in the ecosystem?
Yeah, so I think the biggest advantage of something like a USDG, which we've as I mentioned before, partnered to launch with folks like Kraken, Paxos, Robinhood, is basically this idea that as stablecoins propagate throughout the world, if they are going to be, like I said, a strategic asset of the United States, there's probably a few things that you want to have in order to have a stablecoin be that popular. I would contend that the first thing is making sure that everybody that kind of participates in the growth of the stablecoin is able to participate in that way in a financial mechanism. So look at dollars. The way dollars work is basically anybody who holds dollars, which is say in a bank account, they get to participate in the yield there, maybe pass some of that back to their clients. Right. Anybody who runs a payments business is able to charge some percent of transactional volume, whether it's peer-to-peer payments, whether it's credit card processing, or whether it's international remittances. There's a natural business model that gets built in on top of that. And so if we're looking at how can we actually create a truly global stablecoin, it probably needs to be something that shares economics in a way that incentivizes all the players to get there. And so that's the core theory of USDG is, what if you were aggressively interested in sharing the economics with all of the market participants? Could that be a naturally viral product? And so tangibly what that looks like is any custodian that is holding USDG gets to participate in the underlying rewards system that USDG has. So USDG holds a series of treasuries underneath, and then any custodian, or what you say, exchange distributor of that stablecoin, gets to have some of the economics that are related to the underlying holdings that they have. And then many of those custodians, exchanges, fintechs will decide to share some of that yield back with their clients. And so what happens is that you have kind of a natural business model add-on that comes with dealing in stablecoins. It's not kind of all going to one entity, but it's kind of more fairly getting shared among all the participants that are part of the network.
Yeah, it makes sense. So essentially, an analogy is the current stablecoins out there are more like the old school banks where interest was just held by them, never really passed along. And USDG is more akin to the high yield savings accounts that have come out from fintechs and the others and gotten so much adoption, just sharing the pie with everyone else.
Yeah, that's exactly right.
Nathan, so we have a section we like to do in the end where it's 5 one-line or one-word answers, quick fire, which we like to do. So the first one here for you is, who is your favorite voice in crypto?
My favorite voice in crypto?
Yeah. It could be a person on Twitter. It could be someone you watch on TV. It could be someone who speaks to you privately.
Satoshi. I still like some of the old Satoshi quotes. Yeah. Like if you don't understand, I don't have time to explain it to you. Some of these kinds of things, and so I think I'd go with the classic Satoshi.
Okay. What's like an opinion you hold that's contrarian right now?
Contrarian opinion I have, the business model for tokenization is not clear. So I think it's still an unsolved question how to make it work to tokenize all the assets. So when I was talking earlier about there's a big opportunity there, I believe that. I believe there's a big opportunity. I still don't get what the business model is and how we're going to get there. And
Could
so
you elaborate maybe on what do you see missing today in some of the business models that have been done so far?
Yeah. So what's tricky about it is, let's say you're even you guys or another maybe traditional issuer. So let's say like a large credit fund or a large ecosystem partner that has a lot of the assets. They actually don't want to pay much to move the assets on chain. So there's not necessarily a revenue model that comes from bringing assets onto the chains. And then our entire point here is to make it easier to settle and faster and cheaper to settle. Therefore, there's not a revenue model that comes from, shall we say, settling the assets.
Right.
So there's not a model that brings them on chain. There's not a model that helps you when you're moving them. And then people expect to pay very low custody fees on top of these assets because they're not necessarily bearer assets in the token form, and so the security of it isn't as critical. And so all of the naive ways of making money there's actually very little margin. And so if we're going to try to bring trillions in assets on chain, what's the point? Basically. Right. And so like this is what we got to figure out what is the like revenue economic model that is going to make that make sense in order to drive the evolution. And so I think that's a thing that still needs to get figured out. And this is I go to all the RWA conferences, I go to all the different places here, and this is what I ask people. And so far, I haven't heard a real good theory for how it's going to happen.
So do you think this is, and I know we were doing rapid fire, but I think this is interesting to talk about regardless.
This is much more than one word, but yes.
So do you think it's a problem of entrenchment where these traditional issuers are happy making the fees they're making today because they're able to charge them? And it's a question of adding some other revenue model on top or some differentiated revenue stream here, which makes that jump make sense for them? And is there a world in which they're making less revenue with tokenization and they're still inclined to do it? Like, is there a liquidity bump that they get from it or something else?
Yeah, I think it needs to be something like that. And so this is the part where it needs to be figured out. One way I've heard it described is the 101% problem. And so think of it as you're a traditional issuer. You've got a huge pile of assets that you want to tokenize. And let's say it's 100 times better. The OpEx to run on top of tokenized assets is 100 times better. So what's your cost now? It's 101%. You still got to run the whole existing thing, and you've got to run the new thing that costs 1%.
Right.
And so that makes it kind of hard for anybody over there to swallow that it has like a large, say a traditional bank that has a lot of assets. So maybe it's liquidity. Maybe there's additional liquidity, and the liquidity premium helps out here. But the truth is that TradFi is really, really good at trading things that they want to trade. And so I think of that one as like that. I don't know if it's a Taylor Swift song, but it's like if they wanted to, they would. Right. Like if they wanted to trade these things, TradFi would have figured out how to make these things tradable. And so I wonder about the liquidity idea as well. So where does this leave us? I don't know. I have it's obvious that there's like a better future that can be built, but the set of steps to get there needs to be written, and it's one that I think a bunch of VCs should fund experiments in this area to find like what is the way that it works, because we need like kind of an exploration.
Yeah, that's
what do you guys think? don't mean to like turn it around
No,
for you
this is
guys.
great.
So you guys decided to tokenize. Like, why did you do it?
Yeah, I think there's like twofold. I think I agree with what you were saying broadly, right? Which is, look, if you can't charge for it and people don't want to pay like transaction fees in general, like where is the incremental revenue? For us, this is not meant to be a revenue driving like initiative. It's more for two things. One, opens up the landscape of players that could participate in this that maybe traditionally weren't going to be able to. But second, provides liquidity in an asset class that was not liquid before. And so now you could, previously it was, okay, look, if you're giving private credit to a company like us for 2 years, there is no secondary transaction, if you will. You're in that sort of investment for a 2-year period. Now what you can do is say, look, after a year, maybe I need that capital back, or I have other things I need to do. Here I can go and easily transfer ownership of that. Now you can do that sort of without tokens as well. This just makes that slightly easier. And then the last thing I would say is more technologically, you can do things such as token gated dashboards and have better like reporting to your sets of folks that hold the asset, which make it much easier as well. But I would say it had nothing to do with like, let's just tokenize this to be a tokenized sort of private credit asset, if you will. But it does drive a lot of efficiency under the hood. But it's not meant to be a revenue driver.
Well, I think, Nathan, for us, it goes back to what we were talking about. It's not that fees and all are different or lower, but it gets us the liquidity premium, right? So for that reason, it makes sense for us, as Dhruv mentioned. There's another thing. So in traditional debt markets, you can have a loan book for a few years. You can get securitized. Dhruv actually did that at Brex. There is no rating agency that's going to rate a crypto collateralized loan book today. Maybe that changes. So we can't get securitized in the traditional markets and be able to access that massive liquidity bump that you get from it because you can keep selling your loans forever. Now we can do that by creating that same mechanism through tokenization. So it gets us access that we wouldn't have had to that kind of product. So I think our situation is a bit more unique, where we didn't have access to the traditional markets the way some of the other issuers do have today.
Yeah, I think it's actually really interesting your use case, and I'm going to be really interested to kind of see how it plays out. And like, frankly, very very excited to be partnered with you guys. I don't want my contrarian view here to be at all perceived as I don't like this area. I actually think we're the biggest custodian in the world right now for RWAs for tokenized assets, and so we're in this in a big way. I'm just I really want to see how it plays out and understand what the fundamental margin drivers are.
Well, I think your concerns are valid, right? And I think for most people doing RWAs, there's no reason to do it for the most part. Like bringing stocks on chain is not exactly the most notable use case in my opinion. But for us, our situation, as we described, is fairly unique. So for us, it does make sense. And I think it will make sense for a lot of lenders moving forward to do the same thing because it lets them access this massive liquidity premium, which they couldn't have earlier because they can't get securitized. Awesome. You asked us about our contrarian opinions, Dhruv.
In terms of like contrarian opinions, I think one that I may have more so from like the company building aspect is like raising less can often be better. You know, I think right now many companies are looking for like large, massive like equity funding rounds. But for us, with our story about Arch, really it forced us to be super creative and just resourceful with the equity dollars that we did have, and we were able to go a lot farther and really, I think, set our business up foundationally way more successfully than would it have otherwise been. And so maybe that's like the current contrarian opinion.
Yeah, I think it kind of forced us to be conservative on the risk curve, which I think as a lender is very important. And, you saw what happened with people not being conservative. And I think we'll continue to have that mindset because we've truly built it in our business and we are always going to be very conservative. We're always going to have conservative LTVs and be very conservative with how we handle collateral. As you mentioned, tri-party earlier, that's what we do at Anchorage. And everything has like very strict covenants. So I think it's been very helpful for us. And I think more people, when until like 2021 or even 2022, like we were in this like ZERP era where it was really cheap to raise capital, and it was a focus on growth at all costs. I think as we've all discussed over the years, that has changed, and the focus now is on like sustainable growth. So we're really trying to focus our growth in a sustainable manner, so that we have a long-term business. Like really what we're building here is a private bank for people to live the rest of their lives with, right? So this is not something that lasts 1 or 2 crypto cycles. This is something that lasts a lifetime and beyond.
Awesome.
My contrary opinion, you kind of put me on the spot there. I should have thought of this earlier. I actually would have, if I had to take a cop out and agree with you here. I haven't seen much use case for tokenization or RWAs. Like just like you, we've been to a lot of the RWA conferences, and a lot of it feels like tokenizing for the sake of it because it's a cool new technology, and it's like it gets people on chain, and it's a TVL play for protocols to increase TVL, and a lot of these tokenized RWAs have approached us now about lending because they want off-chain lending because that actually counts as positive TVL, not as debt. But I don't see the use case for most of them. Obviously, there are nuances like ours that I mentioned. I think there are a few others as well, but I haven't seen clear use cases as to why this would make sense. And as a result, I haven't seen interest from like the biggest issuers outside of BlackRock, obviously, to really participate in a meaningful manner. I mean, there was that news about KKR offering a part of their fund tokenized. I think it was a couple of years ago. And that was really a very meaningless portion of their fund that they offered, and it was one fund of the several that they operate. So I agree. I think the incentives have to come out and be aligned. But I do think that now that there is just so much more institutional interest in the blockchain technology, in cryptocurrencies, in how to like utilize this to make processes more efficient, and there's also focus on cost cutting, on being financially prudent. Maybe there is a future where there's more incentive to figure out the business model, which hasn't been the case so far.
Yeah. And Nathan, I know we're running up on time, but we have 2 last questions here for you.
They'll be shorter.
One is, what is your favorite financial product? That's obviously not Anchorage or Arch.
It's slightly a cop out, but my absolute favorite one was securities-backed lending. Okay. And so I was, after some amount of time after I left Square, I went to my financial advisor and I said, "Hey, I've got this tax bill. I need to sell some of my options in order to afford my taxes." And my financial advisor said, "Like, what are you talking about? You can take out a loan for your taxes." And that was like the greatest financial transaction I ever made. Not selling at $9 for Square, and it like went up to like hundreds. And so that one was like kind of the most meaningful for me at a time when it like very meaningfully changed my financial outcome. I grew up in rural Indiana, and so I had no clue this stuff was available. I was like, well, I gotta sell. And my guys were just like, no, you don't. Yeah. And so that surprise, and then the way it like turned out for me long term, was wonderful.
It's that awareness we're trying to build with our education as well. Like if you hold Bitcoin, like Bitcoin, I think is one of the best ways of holding savings. I hold most of my savings in Bitcoin as well. And buy, borrow, die is something people have been doing in the private banking world for generations. And that is what you should be doing in crypto as well. And also with securities, we have a separate product where we lend against pre-IPO equity and options. And people in a similar bucket as yours who borrow to pay off their tax bill.
It's perfect. Love it.
2 very quick questions. These should be easier to answer. The first, and I'll ask them both so you can answer them both together. So the first would be, what is your most influential book that you've read? And the second is, if you weren't in crypto, what industry would you be in?
Sure. So I think my favorite book is probably Titan. This is the story of John Rockefeller.
Yep.
It's an incredibly long biography, but man, he knew how to do it. And he was like so successful that they had to pass laws against him. Like that is the business Hall of Fame.
Yeah.
When they have to pass laws against you because that's how successful you are. That's getting your jersey up in the stadium. And so, what he was able to pull off was incredible. So Titan story of John Rockefeller. In terms of industry that I'd be in if not for crypto, hard to say. Maybe media,
Really?
maybe defense. I think there's like a lot of like interesting stuff happening in defense these days, particularly with this whole thing that like is going on with Doge. About like, hey, how can we be wildly more efficient,
Right.
and also like kind of more effective in the defense of the nation. So that's one that I might be interested in. And then the other one is just kind of media. I think the stories that we tell end up shaping the culture in very deep ways. And I think it'd be fun to try my hand at that at some point.
Well, I think you have a great opportunity in both. Media has just gone through a route. A lot of it has been exposed as blatantly just driven by one side of the political spectrum. And I think there's going to be a massive opportunity in creating trustworthy media over the next media outlets over the next few years. And the second, I think on defense, you hit the nail on the head. Like that's going to be a massive opportunity. Companies like Anduril obviously are well positioned in that space, but it leaves the opportunity open for a lot of other homegrown companies that are more efficient and can win contracts at much lower values than the biggest companies like Northrop Grumman and GE and such.
Yeah, I think it's going to be a real renaissance in both of those areas. So it's exciting.
Yeah. Well, Nathan, thanks for coming on. I know it's always a pleasure when we have a conversation. And so we're really glad that we were finally able to do this, and looking forward to the announcements that we have coming out with you all as well in a couple of weeks, and sharing that as well.
Yeah, it's going to be good. Thanks a lot for having me on, guys. This was a blast.
Thank you.
Appreciate it.
Really
Thanks, Nathan.
appreciate it.